All right, welcome back, everybody. Markets this morning reacting to Ukraine hitting inside Russian territory with U.S.-supplied missiles. And joining us right now to talk about the market's reaction, but also the bigger forces moving the markets right now, is Peter Kraus. He's the chairman and CEO of Aperture Investors. And Peter, the immediate reaction this morning is a muted one. We're continuing to watch geopolitical events. We did see futures drop. It's not a massive move, maybe down a little over half a percentage point for the Dow. It's just part of the continuing issue. Probably the bigger forces moving the markets right now are the Trump election and the new administration coming in, and then what the Fed does as a reaction to the economy. How do you add this all up? Because when we started the year, you had a pretty optimistic outlook. You changed it in July to say you were a little more concerned about some of the things that could be happening. How do you feel right now?
Well, it's a little uncertain, I think, and I think the market's reflecting that. Volatility since the election, inside the market, the volatility has actually increased reasonably significantly between different stocks and bonds. And the market itself has been kind of listless, not particularly directional.
That first week, there was a pretty big
up
move
5%, but then down 2%. So that's sort of the part of the volatility. I think there is uncertainty here. We don't really know what the administration is going to do with tariffs. We don't know what they're going to do on immigration. We don't know what they're going to do on taxes. We know what the broad headlines are. We don't know exactly what's going to impact the different parts of the economy, and people are going to allocate capital and make big investments. I think we will grow. I think there will be growth here. I think 18 months, 2 years, we'll see significant injection of capital into the economy. Manufacturing is relatively low. Destocking has been taking place over the last 2 years. We should see restocking. We should see growth. But I think people are going to wait, and investors are going to watch, but CEOs are going to wait to see how this clears up before they start committing capital.
I guess the other question that is, if we see growth, is that growth strong enough that how the Fed plays into some of this, too? This has been a huge win where we've had a pretty strong economy. Companies have been able to continue to deliver on the bottom line, and it's all happening while the Fed's moving to move interest rates lower. And that's a pretty hard force to change. Yeah,
I think the Fed is going to continue to lower rates, but at a slower pace. I think the short rates are probably still too elevated for a normal environment. So you'll probably see 25 basis points in December, and next year probably 25 to 50 basis points. But I don't think, unless the economy gets really hot and inflation comes back in force, I don't think that the Fed's going to reverse that.
Okay.
And I don't think the Fed's going to drive rates down to some lower level unless there's a recession.
So if you have that massive deregulation and lower taxes, which we don't know exactly what the taxes are going to look like, but I think it's a safe bet that taxes will be lower than they would have been under the Harris administration, and probably than where they are
I think
now.
You'll have growth. So I think you'll have growth, and I think you'll have the market will do reasonably well to well. And I think companies' earnings will do well. I think the interest-sensitive assets will struggle a bit because the rates are not going to come down that much. So, private equity, real estate, things like that are sensitive to levels of interest rates will have to not struggle, but figure out how to restructure themselves in that environment.
What's that mean for housing, which has been a big issue?
I think people's incomes will grow. I think that they'll be able to afford at least to fix their houses and change things. So you'll see housing-related stocks or stocks that affect improvements in housing do reasonably well. How it's going to affect home builders, that's a little bit of a challenge because, interest rates, again, are very sensitive to those kinds of activities. And I think that falls sort of in the real estate camp. It'll probably be more challenging for that to grow.